Good afternoon, everyone, and welcome to our investment market update. As always, I'm joined by Kenneth. So thank you, Kenneth, for joining us.
Thanks for having me.
Okay, so similar format to as we normally go through. Three main areas today. One, we're going to look at the reporting season update. So that's both in Australia and the US. Roll into the Australian economy. So look at key things: consumer sentiment, inflation, and the all-important RBA cash rate expectations. And then the third component of that is just the investment strategy, so fixed interest outlook and the market outlook. And then we'll close that out with my favourite part. I like to call it keeping Kenny honest segment. So we're going to look back and see what was said 12 months ago and just to see how that panned out.
Sounds good.
All right, let's get into it.
As always, we have our disclaimer. But on to reporting season. I actually think moving into this half-year reporting season, it was one of the more challenging environments that we'd witnessed over 2023, and there was a lot of fear out there. I think importantly, this reporting season was actually far better than feared. And when we looked through it, there was some pretty significant beats, particularly in that mid-cap to small-cap range, so small companies to medium-sized companies. And why was that? Well, when we went through 2023, everyone was worried about cost of living, margin pressures, interest rate costs have gone up. And where you feel that is in smaller companies, more so than larger companies.
Yep.
So the expectations moving into February were actually really low. And I think really pleasingly, it was better than feared. So we always have this graph on the left-hand side. We can see how expensive the market is, and we've gone back to August 2019. So that's on that left-hand side there. We're sitting at around 18.5 times forward price to earnings. So for every dollar of earnings that a company or the market is producing, you're paying about $18 for it. You can see there that it's middle of the range. So we wouldn't say it's expensive, particularly when you look through some of those other periods. I would caveat that with, well, maybe the earnings were a little bit lower through that 2020, 2021 period coming out of COVID. But onto the big end of town, that was actually a little bit lackluster. You can see that there was a bit more of a jump up in companies missing, but still not so bad on the beats either. Wasn't one of the best reporting periods for large caps. Really felt, I think, in a couple of areas. So if you look through, so BHP had a couple of issues itself. That's 10% of our index. So it does move this number. And then onto the right-hand side, I like to see this because it's around, well, where did we start? And then by the end of February, where did we finish? So I think really importantly, we actually saw around about just under a 10% uplift to earnings revisions. That's a positive sign. That means that as analysts have come out, they've seen the results, they've talked to management, and they've upgraded their expectations. Certainly not in a straight line though. So you can see there that there was a couple of the larger end of towns, and in particular, I'd focus on the Domino's and the corporate travels. This is just broken down into sectors, so don't be thinking that the left-hand side is the worst or the bigger downgrade. On the right-hand side, though, I think what was really interesting was some of the upgrades in the discretionary sector. So JB Hi-Fi, Harvey Norman's, Wesfarmers, so that's Bunnings, Kmart had an absolute standout, and then AB Eagers. So that's an area which everyone thought coming in was going to have a really tough reporting period. But not only did they come through that and get better than expected earnings, we've actually seen some upgrades to numbers as well. So onto more of a bit of a macro picture in terms of reporting season. This on the left-hand side, you can see that, well, this is around the targets. So analysts come out and they have targets for companies. And where are those companies now trading relative to the company's share prices? So we've actually had a really big catch up through the back end of calendar year 23, where there's been a big narrowing of the discount compared to where those price targets were. So we've focused on the industrial sector, but you can see there that it's actually been a very, very solid November, December, and January period. On to the middle section of this graph, I think, and it's a running theme through this presentation where we didn't see too much in terms of the large cap, so large companies, price action and market revisioning, so earnings per share going up or down through reporting season. So very, very benign. But where we did see large movements was in the mid to small cap area. And I think it just goes back to, well, it didn't need much to see these animal spirits start to really lift off. There wasn't that much of a change on the median earnings per share outlook for a small or micro cap company. And you can see that there. But you saw a really big price reaction. And that just meant that there was so much fear over missing those expectations, that it was almost like a relief rally. So that's and really, really good to see that small and middle-sized company doing reasonably well. On to sector returns. So I think, as probably most people have seen with the information technology companies in the US, it was a great return in February, also followed by consumer discretionary. That was, I think, one of the standouts. No getting around it. There was a lot of pessimism going in, but we did see those really strong returns. And this is just through February, so we've just focused on February there. But what lagged? So materials, I did touch on BHP. That's going to move that materials index around. And I think just as unexpectedly has been the energy sector. So the energy sector, there was a pretty big risk event through the back end of last year where there's a war that broke out in the Middle East. The expectation from that point on was that energy would be an underperformer, but it has not. It hasn't been the case. Finally, well, where do we see the opportunities moving out of reporting season? And I think there's no better place that we're looking at right now than in those smaller type companies. And there's two things that we're sort of focusing on in this graph. One is the actual valuations. So where are the smaller companies trading relative to the larger companies? On the left-hand side there, you can see, well, we've gone back through to 2006. It's basically as cheap as you've ever seen it. Yeah. So I think that there's a reasonable chance that mean reverts. So we do start to see that lift. Even if they're not outperforming on earnings, it's getting that same price reaction that I went through on the previous graph, where even if they hit their numbers, we're seeing a little bit more relief rallies going through. So I think that was a really big key focus for us moving in to calendar year 24. And then on the right-hand side, well, how do things go when, this is highly topical at the moment, when interest rates stop going up? So we've gone through this really, really solid period aggressive period of interest rate rises globally. Everyone's had this inflation story for about 2 years, and we're finally starting to see that central banks around the world are either slowing, stopping, or going to reduce rates. And so when you look at how things go over a first and second period of when interest rates have stopped, you can see there that growth and small caps actually do really, really well. Obviously not in the second half. You'd probably move towards, well, maybe I'm looking down the barrel of a recession. And so that's why that changes so dramatically. But in that first half, it's a really, really strong period to remain invested. And you can see that through almost all of the areas there. Onto reporting season in the US. And I think it's just incredible that they've been able to achieve this in the US, because if you'd spoken to almost anyone 6 or 12 months ago, there was talk around recession. They were going too hard on interest rates. Inflation was falling rapidly. Well, the companies themselves have proved far more resilient than all the markets were anticipating. So this is their full year. So they run calendar year for their reporting season. Really, really strong results almost across the board. You can see there that there's been roughly around about 70% on average of their companies outperforming their expectations. Clearly, there's always going to be some softer marks there, but I think really, really solid on a top line picture. The other area that we've focused on here that, when you go back a year, what was people expecting? It's going back to those earnings revisions to what was actually current through, and this is taken to 1 March, so it's through their reporting season. You can see there for almost all of the sectors, we saw some either increases to the earnings revisions, which is good, or in line. The only two sort of areas, and you can see there to the bottom right, where we saw some negative numbers again, particularly in that energy space.
Some consistency there between the Australian and US.
Agreed. This is highly topical, so I thought I'd put it in there. Everyone's talking about AI at the moment, and this just shows you that for a number of years now, there wasn't any discussion on earnings calls around AI, what that's going to do for companies. But as ChatGPT came to the fore, and as we've moved through the last 4 quarters, it's actually been an almost exponential increase. And it's a real thing that companies do need to have an AI strategy, whether that's simply going through and utilizing some of those amazing US tech company focuses that on their software and how that's being implemented through, or trying to bring it into themselves. But it's highly topical at present. So onto the Australian economy. We've focused here on a couple of, I think, key areas that were really, really worrying through 2023, and that's really how the consumer has been able to deal with these large interest rate increases. So you can see there that we had some really, really pessimistic consumer sentiment almost for the year, and that's really hasn't been as low as that outside of COVID for decades. But what we've seen just recently, we started to see the consumer sentiment pick up. And why has that been the case? Well, we think it has a lot to do with inflation. Inflation, as you can see to the left there, has been falling, and has been falling fairly rapidly. The last, and it's a debatable topic on which one you would use, but the last monthly read was around 3.4%. And it's not going to be in a straight line, but there's clearly been a very, very swift descent of inflation. And that's giving, I suppose, relief to consumers. They're starting to feel that, the worst is over, and we're seeing that pick up. And so what's that translating into? Well, we think that that's started to show up a lot in that consumer discretionary area. We've just taken a subset of groups that we follow through reporting, flat until their results came out, and then we've seen these large increases, which is really, really good to see. Some key aspects to this as well. I think when you're looking at the retail sector, they're at the pointy end of the consumer. There's no doubt about it. They actually didn't see, I think, really any pain in terms of sales growth. We saw that flow through. Volumes were down a little bit. Their gross margins actually remained or were far better than anticipated, and that's a lot to do with that freight cost coming down that we saw. There was a lot of bottlenecks through calendar year 22 and calendar year 23. That has definitely gone down. Where are they seeing some pain though? And that's in the cost inflation. So wages and leases have been going up, and you should be able to. We've got some other data on this, but that's a running theme through the Australian economy right now. But all in all, they've actually done really, I think, a really, really fantastic job, and we're now at the back end of that. With inflation comes interest rate expectations. So what we try and do is take our personal view out. We just look at what the market is expecting. So we take 24, I think it's about 24 economists through the Australian. There's a marketed amount more in terms of the US, and we're just looking at, well, what were the interest rate expectations in November last year, and this is just the implied value, and then what are they at right now? And so you can see there that there's been a very, very closely correlated in the US, and we predicate that on the fact that they're about 6 months in front of us. So there's a clear linear trend there that we're starting to see their interest rates move from about 5.2 down to about 4%, a little bit above. In Australia, though, if you'd looked in November, and this is before we saw GDP, we saw the CPI data, home approvals through December, that we're actually, no one was really expecting a cut. There was very, very little pricing. You had to go right out to even see a remote chance. That's changed, and the dark blue line showing as at the 11th of March, we're now expecting that the interest rates, there's about 1 to 2 cuts priced in to the market right now.
Okay, just in respect to that, when we're seeing inflation going up and then in the interest rates going up, and concern around how far those interest rates go and making sure that the economy isn't stalled and so forth. I've probably got a couple of quick questions off that there. The expectations as to where a normalised RBA cash rate, if there's such a thing, for the economy over the next period, and what that consensus looks like, and the GDP growth outlook for economy.
Yeah, okay. So I'll address the first one. Really, really difficult to give a normalised RBA picture.
Yep.
But what we would tend to look at is, well, if the RBA is targeting a neutral rate, so there's a neutral rate, and that's called a Taylor rule, where you want the policy to be neither expansionary or restrictive. And so if you've got your unemployment rate to the natural level, what you'd be looking at is going, well, if the RBA would like a 2 to 3% inflation target, then we would tend to say that the RBA's neutral rate, if everything's all in all, would be around about that 2.5 to 3%. And then on to the GDP. So GDP was far weaker than anticipated. And I think as we're moving through this period, this is something that we definitely need to be on top of, particularly because we're starting to see that weakness in terms of the materials space, a big driver of our economy. The expectation is that we don't go into recession, and that now, what we do need to see is that start to slow down, though. The rate at which GDP has decreased is, I think, concerning. What we want to see is a more stabilised environment there, and I think the RBA will be well on top of that. On to inflation. So we've just focused on the December read. And I think that most people right now, or most market participants, do still focus on the quarterly number. And it's still, while dropping, there's still some areas there that that we would highlight are still going to concern the RBA. So the red being an increase. And so we're saying that's bad because inflation will continue up. You can see in there that housing is still going up, and that's a big component. I think food, transport, and alcohol also. And so we're not all the way done here in terms of bringing inflation down. We will say that the monthly read was around about 3.4%. This is a 4.1 at December. So the trend is still there. It's going to be volatile. It's not going to be in a straight line. We're hopeful that we're through it. And I think that the big constraints that we saw over these last couple of years are starting to, or certainly have begun to ease. So on to markets. Last April, we were looking at a period of time where interest rates were still going up. We saw pretty severe dislocations in terms of some of the market indices that we follow. And everyone was really, really concerned about what this is going to do to the economy. But how restrictive were rates really? And I know hindsight's 20/20, but if you had dropped out of the market and moved into, sold all market exposure. The Nasdaq, the S&P 500, the global markets, they actually had a very, very strong year-on-year performance. So I think that while we do focus on interest rates, of course they matter to consumer. They do matter in terms of putting through discount rates, but it's just showing you that there's a lot of movement that can still happen while they're still going. So Nasdaq all-time highs. Cash in money market funds are still at record highs. So it's an incredible period. And staying on that same theme of being invested, when you look through, and I think this is one of the better graphs throughout this presentation, when you look through, the drawdowns seem really, really painful. When you're going through it and you've had to deal with, maybe the Nasdaq fell 30% and you're holding that position, or you're looking through a GFC or a .com. They feel like they go on forever, but they don't, and they're actually nowhere near as long as equity markets going up. And I think that if you look down on that graph, you can see that all these little pain points along the way. They tell you what the drawdown is as well. So really, really tough .com, 41%, hugely tough GFC, and how long that lasted for. But coming out the other side, you can see that the length of time that the markets go up and the amount far outweighs the pain that you have to feel. And so our investment strategy is always to remain invested. I don't think there's a better way to show that.
Yep. And it doesn't mean that you can go, underweight or overweight sectors depending on thematics. It's just to maintain market exposure.
Maintaining your exposure, in accordance with your risk tolerance. Yep. Moving back towards interest rates and then what the implication is for investment strategies. So you can see there, we've just done a global picture here where we're expecting I suppose interest rates to head, and then where they are right now. Almost everywhere is starting to drop. But what that means for risk assets. So risk assets onto the right-hand side, we've looked at the S&P 500. You can see that on day zero is the last interest rate cut. And then on almost every other occasion, it has continued to rise. Some obviously not so much as others, but the only time, and we've looked at it, was the .com era, that through that period of time that there was a negative return. So again, it's actually shaping up to be really constructive in terms of holding equity exposure right now. And now we've sort of looked at, well, where we see the ASX 200. So going away from the US, we've just had a look at the last few years. You can see that there's obviously been some pretty significant points in terms of the global picture. But our case right now is that we're reasonably fair value. We're sort of there or thereabouts. But if there was to be a turnaround in China, if there was to be some significant stimulus pushed through there, and we did see a really strong materials case come through, that's our bull base and bear case. So 8,200 is where our expectations are. The base case is there or thereabouts, and we only see around about a 10% downside picture. So look, and there's a lot of things to continue on. We are really going to start heading into a US election cycle. There's going to be a lot of mud thrown, I'm sure. We believe anyway that we are near an inflection point within the interest rate cycle, and I think there's a couple of key areas that we need to look at, but none more so than making sure that domestic spending still remains there or thereabouts. Onto a couple of areas that maybe don't get as much attention. So we always like to go through this. Everyone's different, but we're full asset allocators. And I think the fixed interest sector is, in all honesty, at the best returns that we've seen for a number of years. So as interest rates have gone up, traditional fixed rate bonds, they need to sell off in order to give an acceptable rate of return. Now that we're through this interest rate cycle, or thereabouts, you tend to look at it and go, well, for the return that I'm getting on a bond, relative to the risk that I'm getting if I'm an income investor, so we focused on the Australian dividend yield, how does that look over the next year? If we looked at corporate debt or government debt right now, you're basically getting a better return in terms of income only, so take out growth, in terms of income only, holding government or corporate debt. So that means for a lot less risk, you're getting either a better income return or a very, very similar income return. Both of these graphs go back a fair way. We've never seen an equity risk premium diminish like this, unless you were through some pretty significant pain points like the GFC. An area that
I might interrupt you one there, just based on that interest rate outlook. If we're at that inflection point now, certainly consideration around your floating versus fixed rate exposure.
We tend to we are active in terms of our exposure. We have been looking at different products or different securities there, where you want to start locking in that fixed return rather than taking the volatility in a floating rate return. So floating rate just means that you're getting a fixed margin above a benchmark, a reference benchmark. And so as the benchmark in our case is really set off the RBA cash rate, which goes into the 90-day bank bill swap rate, that moves up and down with interest rates. So as interest rates have moved up, you're getting significant returns through income alone on those floating rate notes. If they start to fall over, interest rates start to fall over, you're going to get less income. If we looked at a traditional fixed rate bond, that's different. They have price action volatility, so they get sold off to basically hit where the benchmark is. So now that the bonds are at, we think, a very depressed level in terms of priced value, you purchase those bonds, then they go back up to $100 or whatever the case may be, and you're locking in a return that should hold value as long as interest rates stop going up. On to, I think, what's going to be a very topical area through calendar year 24. Through this reporting season, we've seen a huge amount of M&A. And so that's mergers and acquisitions and takeovers. And some are private equity, some are not. We do think that there's a lot of cash on the sidelines waiting for some of these depressed valuations and reporting season to come through. So I think it's a really important time to have a look at not trying to pick which company is going to get taken over, but having a look at some areas having a look at some areas where you can gain exposure to that. And we think alternatives, particularly in the private equity space, are going to have some fantastic opportunities arise. So on to our expectations moving into FY25 and beyond. I think that the inflation picture has moderated quite substantially, but we think that this is going to start to change. We think that once we're through and we see these next round of numbers flow through, there's going to be potentially some interest rate cuts on the back end. And as to your point, well, how do we go about managing that? So it's starting to lessen the exposure to hybrids and move into that fixed rate, unlisted debt or fixed rate products for some clients. We actually think that there's a pretty good opportunity right now to just remain focused on quality. And so quality gets better now, but it's a factor. And we've really tried to look back and go, well, through this next period, there's going to be some dislocation in the correlation for stocks, so pairwise correlation. And I think that there's going to be a really big push for companies that have been able to withstand some of these shocks that we've gone through and have come out the other side. So we're focusing on two particular areas. One, we always like Qual, QHAL, it's a hedge. We'll talk on hedging a little bit later, it's just there. But the other one is a small to medium-sized company ETF that focuses on those specific factors. And as you can see, that we think that there is an opportunity in small caps. So this is how we're looking at it.
If I might just pull you up there, just for our listeners, the factors you refer to in an actively managed ETF or exchange traded fund for Qual and the small and mid cap one.
Yeah. So if you're looking at Qual or QHSM, they're really just focusing on strong balance sheets, so low financial leverage, not much debt. You want to see a high return on equity. So how much equity does that business put in? And as long as there's not too much debt, how much is coming out the other side there, the return on the equity put in. And then, of course, resilient and earnings growth. And so they're the three areas that focus in on those two. I did just touch on it before, but the alternative space, I think, is going to have a pretty solid next couple of years. And so looking at some of those areas of markets that will remain uncorrelated. And then finally, we do expect the Australian dollar to continue to rise. It has pulled back a little bit recently, but we would prefer, given where it's trading in the mid 60 cent level, it's really the bottom end of its 20-year trading range. Apart from really stressed times in markets, we're taking the view that we would hedge exposure, so that takes out currency risk.
Excellent. So I think we've just got one more slide after that, which is just on your model portfolios. But before we go there, probably I suppose the first part is to summarise exposures from the messages I'm getting. Small to mid cap market.
Yeah, we think there's an opportunity there to increase exposure.
Fixed versus fixed. Consider your fixed rate exposure for your interest market, yes, as opposed to maintaining floating or to the weighting point.
Yeah, I think the weighting point there is the key, because you want traditional fixed interest to be not volatile. And so if you're taking volatility out, you would be focusing on floating rate exposures, because the volatility is in the income, not the price. So it's a weighting call there. We would never go zero, but yes, we are focusing on fixed rate debt.
And I guess that, just for the listeners, the reason why that is our defensive play is to manage that volatility, which is why you've got to hold that floating rate. Yep. And the third one is just the hedging of the Aussie dollar for your overseas exposure.
I think if you look over the last 20 years, there's been only 3 or 4 times where it's been lower than where it's at now. We think that there's going to be a changeover in terms of interest rate differentials from us with the US. And we also think that if you look at the fiscal side of the picture, so the Australian budget relative to the US, it looks in far better shape, particularly as you move into that US election, where there's probably going to be some significant promises being bandied about.
Excellent. All right. I just happened to have the last year's slide.
Excellent.
From the 12 months ago, so the Keeping Kenny Honest segment. So I'm just going to read directly from this, so we don't misinterpret anything here. First section, dividend and capital management is a positive sign for the health of Australia's largest companies. Small cap stocks struggling. Bit of a surprise there. So
I would say so. That was April 23.
Yep.
And if you look through from April 23 to now, large caps well and truly outperformed.
Yep.
And now it's around, although small caps that were struggling, I think now's the opportunity to start moving back in. So I actually think that that's a tick.
One. All right. Overweight Australian equities relative to other developed markets.
Again, I think that if you took out of the US it would have been the right call. But we tend to have a lot of our investments directed towards either particular exposures solely in the US, so NASDAQ being one. The Qual ETF has about a 70% exposure. MHOT, which is a value-oriented US-only exposure. These are some of the ones that we would typically hold.
Yep.
The US had a barnstormer of a year, so I'd have to give myself a cross on
That's
this one.
1-1. I think just while I might grab something there, you just mentioned that, we tend to use the US and particularly the NASDAQ. And probably maybe just if you'd like to just make a couple of comments around why we use the NASDAQ and then where we're getting that, difference in type of exposure relative to the Australian and why it blends so well.
What we try and do is to have purpose in the assets that we're buying. So high conviction and have a reason as to do it and not blindly do diversification for diversification's sake. We don't think it makes sense. And so when we're holding either direct assets or we're holding exchange traded products or managed funds, we want to have a purpose behind it. And so we look at the Australian market and we go, well, we have some really, really fantastic large cap healthcare stocks. We have some really great materials or mining companies or financials. So they're some of the best in the world, our financials. Where we tend to lack, or we think we lack is in maturity at least, is the technology sector. So we don't have the Microsofts or the Apples or the Visas of the world. And so how we've gone about in addressing our portfolio construction is going, well, what's going to complement what a client would hold in Australia? And that's why we have a focus towards, in the case that you made, the NASDAQ.
Excellent, thank you. I suppose you can extend that to other ETF exposures to, healthcare to get pharma exposure and things like that as well.
Yeah, I agree.
Next one is continue to overweight defensive domestic healthcare.
This one, I'm going to have to say it's a 50-50. I think there's a couple of some really, really good quality healthcare stocks out there. If you go back through, and we're happy to send these slides out, you'll notice that there was CSL and Cochlear. ResMed's had a very volatile year, but the overarching story there is we believe their quality. And that we're finally seeing those earnings upgrades go through. There were a couple that we mentioned through that year that actually haven't had that bad of a year, but they haven't been standouts, which would be Sonic Healthcare and Ramsay.
Excellent. Looking at cyclical energy, bear in mind this was April 23. So at that point, we're looking at cyclical energy exposures to increase given the trims in the prior September. Focused on coal and lithium exposures.
Yeah. So I think when we looked at the September 23, we were actively trimming some of our coal. We had coal exposure.
September 22.
Sorry, September 22. We were trimming our coal exposure. Into April 23, we were actively trimming that. The price action of almost all of those companies has subsequently declined, and it's now something that we're looking at reversing. So we're actively looking at increasing exposure to either coal or beginning positions in some high, or what we believe anyway, are some high quality lithium miners. And yeah, I think that's a win.
The consumer high frequency data started to lag, actively avoiding most discretionary retails. This is probably one of my favourites. Increasing our staples.
No, it's I think when we were looking at that was probably right up until November. It was a really, really difficult time for almost all small cap retailers. I think what caught us a little bit off guard was in that November, the takeoff that occurred in equity markets, and the fact that the data had stopped really regressing, and so the retailers with such incredibly low expectations, which they managed to beat, I think was the surprising aspect moving into this reporting season for me.
So just as an investor, if you're thinking over the last 12-month period, interest rates and inflation, even every day on the TV, cost of living pressures and stuff like that, consumer discretionary is not what you'd expect to outperform. Is it more so around just the expectations of where they were as opposed to the overall performance?
I completely agree. Yeah. Expectations were so low that everyone thought that it was going to be decimated, and it just wasn't. And so this is a really important fact about markets. You can read a top line number where a company increases its earnings by 200%. This is just a made up number. But if the market was expecting 300, it's going to go down.
Excellent. In our floating rate exposure, we believe we've captured most of the upside. So continue to be overweight low volatility floating rate exposure, but start to be active in fixed rate debt.
So I think that's a running theme.
Yep.
And continue to believe in that one.
Excellent. And the last part was continue to favour elevated cash levels given dwindling earnings and lower equity risk premiums.
Yeah, again, I think that almost all the way through FY23 or calendar year 23, that would have been the case. Again, that November-December period was an area where that's when markets really lifted off. So, yeah.
Excellent. So the scorecard is 5 as expected and 2 surprises. I'll take that to pass. All right, next, wrapping this up.
Just wrapping up, we run our just a high conviction Australian equity model portfolios. We've put there, they've got specific attributes of what we try and target for clients. So income, balanced growth. We also have an ethical portfolio that was started in April 20, so that's there. These are our returns relative to the benchmark, and we're really, really pleased with how they've been going. So if you do have any questions or want further information about our models, please don't hesitate to reach out.
And just probably to that extent, thanks everyone for listening to the update. And just even beyond the models, if you do have any questions around retirement planning, asset construction or portfolio construction, cash flow construction and management, retirement planning, wealth accumulation generally, please reach out. We've got a team of focused experts, building deep knowledge as opposed to general knowledge in investment strategy, wealth protection, aged care and personal injury. So please don't hesitate to touch base. On that matter, thank you everyone very much, and thank you, Kenneth.
My pleasure.
And look forward to speaking to you in due course.